Tuned in just in time for Mortgage Moment here on Radio Realty, brought to you today by Alaska USA Mortgage Company. Here with me is your More Money Mama, Rhonda Johnson. RhondaJohnson.net is the website. Rhonda, what are today's rates looking like? Mortgage rates, that is.
Hey, Chris. So we're still looking pretty darn good. We're right at about 4.5% on a 30-year fixed rate with an APR of 4.687. And that first-time homebuyer rate's still looking really nice at about 4 1/8 with a 4.283 APR. So still nice in those fours.
Excellent. I like to hear that. That's consistent. You know, if it doesn't go up too rapidly this year, I think everybody will be better served.
Yeah. No, we're good.
There's a big trend afoot, and a lot of what we're talking about today on Radio Realty are tiny homes, and the trend of 400, 600 square foot backyard little tiny homes. Maybe that's all that's on the property. A couple things are crossing my mind. One, I want to make sure I'm not steering people towards a problem with getting a mortgage later, or when they go to sell their home, creating problems. So what would be a problem with having a tiny home in your backyard and getting a mortgage? Or is there a problem?
Well, potentially. So when you have two fully functioning living units on one lot, then you basically have a duplex, whether they're attached or detached. And detached duplexes put you into a little bit of a non-conforming kind of a property. Now, if you have a nice, 1,200, 1,500, 2,000 square foot home, and you have a little guest cottage in the back or a guest cabin kind of a thing in the back, then oftentimes it can be considered just that, as a guest cabin. And as long as it's fairly insignificant to the big main house, then usually we can get it financed just fine as a single family.
Insignificant in that it's proportionally that much smaller, or that it doesn't have running water and sewer and utilities?
Both. So if it's fully functioning with water, sewer, utilities, and it could be lived in, it could be rented out as a little small home, then we get into a little bit more of a gray area. So,
well, okay, let me run this by you, because, again, not wanting to mislead folks as they consider this. What if it's mobile? In other words, it's not on a permanent foundation, and it's purely personal property, and as it's sold, as the real estate and the home are sold, the buyer and seller on a separate bill of sale could deal with the tiny home, and if they can't come to an arrangement, it could be removed.
It could be, and in that case, you're just looking at a single-family home, you're looking at single-family financing, and even if it wasn't removed, even if it did stay with the home, with it not on a permanent foundation, then it is just kind of like an outbuilding. That's what we would call it, is an outbuilding.
Are you telling me that I'm a bit of a genius then? That's a good idea.
Of course, Chris, of course.
and I don't even look at that as a loophole. I look at that as just being strategically smart. And, hey, if at any time it is a problem for a lender or an institution or your neighborhood or your city or whatever, you could move it out of there if it's not on a permanent. And we're talking about such small footprint that the pure poured concrete footer and foundation that you would traditionally think of aren't necessarily that important.
Exactly. And sometimes where we run into a bigger challenge is not when it's that little detached cabin, but when, say, for example, somebody builds a complete apartment over a garage that's attached to your main house,
right.
Then again, if there's no access from your main house to the secondary unit, then you end up with that two living unit rule.
Close your ears, Rhonda, and now, okay, this wouldn't be the only time that I've helped somebody move appliances out of a place. That's all I'm saying. No, I'm kidding. Now stop it already. I'm kidding. All right, let's talk a little more strategy. Let's talk about, I own a home now. I want to buy another home and then later sell my existing home. But both are going to be for a short time mortgaged. Both are going to be my primary residence in effect, because the home I'm buying it as a primary residence, but I still have my other home. So what is a strategy or two you could throw out there to help solve this problem?
So one of the challenges I see happen is needing the cash from the sale of your primary home, your current home, to purchase the new home. Now, sometimes what we can do is either a bridge loan, where you actually take some of that equity out in the form of a loan, an equity loan, and use that to purchase your new home. Or you could put a very small down payment on the new home, and then when you sell your existing home, your current home, then you could take that cash And we have what they call a recast option, where you would take that equity, go ahead and apply it towards your new primary residence, reduce that principal balance, and then they'll recast that mortgage with your same rate and terms, but reduce your monthly payments now with that big principal reduction.
I've been under the impression for a long time that a bridge loan was, in fact, a separate, isolated loan on property B. So you're living in property A, you acquire property B with the bridge loan, and then when you sell A, you refinance the B property with a brand new mortgage. But that's changed, hasn't it?
Right. No, the bridge loan is going to be a loan against property A, and that's going to be your equity in it. When you sell that property, then both your first and your bridge loan or your second loan would get paid off with that sell, and then any additional equity that you have would be your cash in your pocket.
Okay. Now, that said, assuming you have enough equity in property A to affect that scenario you just described, great. If not, you could very well be looking at an investor style or non-conforming loan with like 25% down on property B then, and a little bit different scenario then. Even though you're going to occupy it as your primary residence, you might have to step up the amount down and so forth.
Yeah, so a couple of things that they're looking for, Chris. There's this scenario that had been happening, not so much in Alaska, but in the rest of the United States, and they actually called it, I think it was termed buy and bail. And what that meant was you own a home on the street and you owe $200,000, and every other home on the street is for sale for $100,000. So you try to sell your home, which you can't because you're underwater with it, and you go ahead and say you're going to keep it and rent it and buy one of those $100,000 homes. Some people would go ahead and buy that $100,000 home and just bail on their old one, never make another mortgage payment on it. So because of that buy and bail kind of phenomenon that was going on for quite a while, they're really leery about people leaving their primary homes for a new primary home. So they're looking to see that either you have quite a bit of equity in the home that you're leaving property A, and that hopefully you could qualify with both mortgage payments, or that you have a larger down payment on property B, and that you have usually 6 months reserves worth of payments for property A that you have in the bank that you could continue to make those payments in the event that it didn't rent or sell after you move into that new home.
You make it sound so easy. The nice thing is you don't need to remember what Rhonda just said, because you can contact her anytime, 226-8815 here in the Homer Anchor Point area, 714-4391 in the Central Peninsula. But Rhonda, seriously, you do make the difficult to understand very easy to understand, and I appreciate that. RhondaJohnson.net is her website. Rhonda, real quickly in the closing seconds, time to close a loan right now from start to finish, still somewhere between 30 and 45 days?
Yeah, we're still able to get them closed as long as we can get that appraisal back.
All right, thank you. Rhonda Johnson with Alaska USA Mortgage Company. More to come here on Radio Realty.